If you spend any time reading financial media or scrolling through retail trading forums, the conversation surrounding digital assets, blockchain, and decentralized technology is almost entirely framed around speculation. You are told a narrative about volatile token prices, high risk retail trading, and unregulated alternative currencies. It is a highly effective distraction. While the retail market treats this technology as a digital casino, the largest asset managers and central bankers in the world are quietly using these exact same tools to execute something far more consequential. They are rewriting the foundational plumbing of global capital markets. The current financial architecture we use today is built on a legacy system of fragmented ledgers, centralized clearinghouses, and arbitrary operational hours that date back all the way to the 19th century. It is a system designed for a world where information moved on paper, and is entirely unsuited for a modern macro environment where capital must move at the speed of light. Today, we are moving past the speculative noise of the crypto market to analyze the cold, operational reality of institutional finance. We are going to look at the massive friction points currently trapping trillions of dollars in global liquidity, the structural push towards 24/7 markets, and how tokenization is being deployed not as a speculative asset class, but as a mandatory software upgrade to the plumbing of Wall Street. To understand why the financial elite are re-engineering the system, you have to understand the hidden vulnerability built into how every single asset is traded today. Most retail investors believe that when they hit the buy button in their brokerage app, the transaction is instantly finished. They see the shares appear in their account balance, and they assume the ownership has transferred. But the underlying plumbing tells a completely different story. What you actually see on your screen is an illusion. The clearing and settlement of that trade actually takes up to 24 hours under the current T+1 regulatory framework. This delay exists because your brokerage firm, the stock exchange, the clearinghouse, and the commercial banks all maintain separate and disconnected databases. When a transaction occurs, these institutions must spend hours manually reconciling their books against each other to ensure that the seller actually owned the shares and that the buyer actually possessed the cash to buy the shares. And I want you guys to think about the absurdity of this setup. In a world of high-frequency trading algorithms that execute orders in microseconds, it still takes a full business day to legally move an asset from point A to point B. And if you trade a stock at 4 o'clock on a Friday afternoon, that capital is structurally trapped in transit until Monday morning because legacy banking networks do not operate on the weekends. This delay is not just an inconvenience. In institutional finance, time is a risk factor. As long as a trade remains unsettled, both counterparties are exposed to settlement risk, which is the danger that one party defaults before the transaction formally clears. This settlement delay creates a massive compounding financial drain that corporate boardrooms are desperate to eliminate. Because legacy ledgers cannot execute instant settlement, billions of dollars in highly liquid assets must be held idle in central clearinghouses every single day to act as emergency collateral. The clearinghouse demands this cash cushion to protect the system against potential defaults during that 24-hour settlement window. And if market volatility spikes, the clearinghouse automatically triggers margin calls, forcing financial institutions to lock up even more liquidity just to keep the trading plumbing from seizing. Now, in a zero interest rate environment, holding billions of dollars of idle collateral was an acceptable cost of doing business. But as we've gone over and established throughout the past couple of videos, that macro backdrop has changed completely. With today's elevated cost of capital and short-term yields sitting above 5%, idle liquidity is a direct penalty on a firm's balance sheet. Capital that is trapped in a clearinghouse waiting for a transaction to reconcile is capital that cannot be deployed into yield-generating assets or used to fund those corporate operations. The financial elite are not upgrading the system because they care about decentralized philosophy or open source software. They are upgrading the system because the friction costs of legacy time delays have become entirely unmanageable in the current environment. The incentive is pure corporate survival. Eliminate the settlement window, free up the collateral, and maximize the velocity of that capital. This brings us to the actual software upgrade, which is blockchain and tokenization. To look past the retail confusion, you must realize that a blockchain is fundamentally nothing more than a shared 24/7 database. Instead of 5 different financial institutions maintaining 5 separate private ledgers that must be manually reconciled over a 24-hour period, tokenization places the asset and the cash onto a single unified ledger. And when an asset like a US Treasury bond, a corporate stock, or a real estate title is tokenized, it is converted into a digital unit of security that lives directly on this shared ledger. The critical breakthrough here is that the asset and the payment mechanism exist in the exact same software environment. This then allows for the execution of what Wall Street calls delivery versus payment to be settled instantaneously. The second a transaction is approved, the ownership token moves to the buyer and the cash token moves to the seller. And this occurs at the exact same time. This is what's called T0 settlement. The 24-hour waiting period is completely erased. The clearinghouse is removed from the middle of the loop, the settlement risk drops to near zero, and the billions of dollars that was previously being held as collateral can now be instantly unlocked and returned to the financial system. Furthermore, because this shared database is governed by code rather than bank branch hours, the market can operate 24 hours a day, 7 days a week, 365 days a year. The concept of a market closing at 4 o'clock or shutting down for a holiday becomes an obsolete relic of the paper era. If you think that this transition is just a theoretical projection for the next decade, you're completely missing the live data. The institutional reshoring of capital into this new architecture is already underway, and it is being led by the most powerful entities on Wall Street. Look at the behavior of BlackRock, the largest asset manager on earth. They recently launched an institutional digital liquidity fund known as BUIDL, which tokenizes real US Treasury bills directly on a public blockchain ledger. BlackRock didn't design this fund for retail traders. They built it for institutional funds, corporate treasuries, and sovereign entities who need a place to park cash where it can earn yield, but remains instantly tradable and settleable at 2 o'clock in the morning on a Sunday. Under the legacy system, if a corporate treasurer needed to liquidate millions in treasuries on a weekend to cover an emergency capital call, they were completely locked out until Monday morning. Under the tokenized system, that liquidation can happen in seconds and entirely outside of normal banking hours. This is the true meaning of the digital asset revolution. It is the institutional migration of real-world assets into a high-velocity ledger system. The financial giants are quietly building a dual-track market infrastructure which will become the future of finance. So let me try and tie this all together. The future of finance is not about the creation of new speculative currencies. It is about the complete rewiring of the rails that carry the existing global financial system. The transition to 24/7 tokenized markets is a structural inevitability because the financial incentives behind it are just too massive for corporations to ignore. Instant settlement completely rewrites the efficiency of capital allocation, wipes out counterparty risk, and eliminates the billions of dollars that are trapped in clearing collateral that really act as a tax on institutional balance sheets. As an active investor, you must stop looking at this technological shift through the lens of headline hype or speculative trading trends. You need to understand that the plumbing is changing beneath your feet, and it will fundamentally alter how equities, debt instruments, and global liquidity are priced over the next decade. All right, that's gonna do it for today's video, guys. Thank you all for watching. Please subscribe to the channel and check out my Substack, which is linked in the description below, as well as in my channel bio. I also want to hear what you guys are thinking. Leave your thoughts, your questions, your concerns in the comment section below. I love interacting with you guys while I try and build this community, and so I appreciate it very much. Once again, thank you all for watching, and I will see you in the next video.